Hi, everyone. It's Danielle from Shareplicity. Happy New Year. Welcome to 2022. And I just wanted to have an impromptu chat with Anirban Mahanti from Seven Investing, because today we had the fourth quarter earnings from probably our most interesting company around the world, at least from our perspective, Tesla. And we thought it was a great opportunity to touch base about the results and also to discuss some of the macro themes, given that the head of the Federal Reserve, Jerome Powell, was chatting today as well. So Happy New Year, Anirban. Nice to see you. How are you?
I am great. It's nice to see you in the new year, 2022. So happy new year to you and happy new year to all your viewers and listeners alike.
Exactly. So here we are, the much anticipated results from Tesla. I thought maybe you'd like to touch on some of the numbers. To me, they looked pretty good. Obviously, there's supply chain problems, cost increases that are feeding through. But even in spite of that, these were really, really good results.
Yeah, the results were like, I was for a minute thinking, is this a software company, that is a mid-cap software company that's like growing really quickly? Because the results really, like, if you look at revenue growth and everything, it makes software companies look like, okay, what are you doing? So, my key takeaway was like, for an industry that is very, very, capital heavy, they generated close to $3 billion in free cash flow just this quarter. And the other, I guess, number to think about is they generated $5 billion of free cash flow in 2021. That is after really spending $6.5 billion building new factories and other capital expenditures. So this is a cash machine right now. If you look at the balance sheet, it's got $17 billion of cash and like $1 billion of debt. It's basically debt free with lots of cash. It looks like a tech company, which it is. I keep telling people it's a tech company. The only other thing I'll point out is that they put a beautiful chart in the slide deck, and I love their slide decks, where they basically show that they are already at in terms of operating margin, best in class, right? And I think it's only going to get better. So that was the real key takeaway. This was a quarter where they executed against all the headwinds, exactly as you mentioned, chip shortages and whatnot, and they had to rewrite the firmware and do all sorts of crazy things to make things happen. And then, as they indicated in the call, they have been basically supply constrained because of various things that they need, whether it's cells or chips and so on. So they're going to produce more vehicles because they were not operating at peak capacity, which again talks to margins, right? If you can work at peak capacity, your margins would go up because you've just got more amortization that you can do of fixed costs. Yeah. So I think it was a fantastic quarter.
Yeah, I should have mentioned to everybody, of course, this is not financial advice. This is us chatting about a company. So everybody, please take it in that context. If you're interested in Tesla, do your own research, seek professional advice. Yeah, so what is amazing is that you've actually had the incumbent car manufacturers, which are not technology companies, that haven't been able to put these runs on the board. I think there was a great takeaway line from Elon in the call, which was basically they had to rewrite the software for the chip shortages on the seats. They were having problems there and moving the seats. And that really shows, because I would have never anticipated that you would need a chip or software to move a seat, but apparently you do, and they're vehicular little rocket ships that they have wandering around. But look, going forward, I think it's really important for people to understand the core of the business. And a lot of people are wanting to focus not only on the 2 new gigafactories coming on stream, which, as highlighted in the call, they are starting very small scale, producing cars out of Berlin and also out of Austin. But what Elon really wanted to focus on this call is that, as you say, they've got too many ideas. They can't do everything all at once. And sometimes the market gets really sad and says, or they do a downer on the stock because they say, well, Cybertruck's not coming out, the compact, the 25,000 vehicles not coming out. And I think this was a really key important that they can still grow their volumes in excess of 50%. just with the existing models. And there's almost like this cannibalization potentially of your existing products if you have to bring these new ones on stream. And I don't think investors generally or other people understand that it's just not the flick of a switch to bring on these new ones. You would have to reduce capacity in the other existing models. So maybe you'd like to talk around some of the forecast volume production and those dynamics.
Yeah, so this is a great point about the push and pull of how many products do you want to have, and especially in a supply constrained environment where you need chips and cells and things like that. On the Cybertruck, the main thing I'll say is that I think maybe they are doing a little bit of sandbagging, because one of the things that they said, and which made me almost jump off my chair, is that they've actually started producing 4680 cells. So this is the cell that has a much higher capacity and the ability to reduce cost. A truck, including the semi, Cybertruck and the semi, would need these higher capacity cells. So they're actually producing it, but they're going to use it first for the Model Y, which has a higher margin, and it gives them an opportunity to actually fix things if things are not going well, scale it. So they've actually figured out how to do the scaling. So I think that's, maybe towards the end of the year, we'll actually hear that, we thought we'll do Cybertruck in 2023, but actually we are going to roll it out now. There is a potential for that happening, given that, and we've also heard that Panasonic is already, making plans to produce the 4680 design, which is a Tesla proprietary design. So I think there's some very interesting things there. The other thing that I say, I draw parallels here between what Apple has done in the past and what Tesla is doing. You don't need to have zillions of different models. People think they need too many choices. They don't. Yeah. And if you put all the features and options that you need, like if you look at the Model 3 all-wheel drive, which was used to be called the Standard Range Plus, is exactly the same vehicle exteriorly and almost interiorly from an interior point of view as the Model 3 Performance or Model 3 Long Range, right? So basically giving people everything, and then the only choices they're really making is like, whether it's a 64 gigs iPhone or 128 gig iPhone, right? You're giving people fewer choices. And this is a Steve Jobs thing. People think they need choices, but you need to tell them how many choices they need. And you see that in Apple's lineup. I do think the product lineup will increase over time, but I think it's a really smart thing to scale. And they're also making lots of changes in the engineering, right? So, body stamping, more robotics and things like that they're bringing in, structural battery packs, work everything out while scaling the volume. There's plenty of demand, work on that, and then go. So I'm not really worried about, I do think they'll have a 25K car in due course. Yeah. I do think they probably have a few other things that they're going to do. They talked in the call about doing other things that come from the R&D, which is like, heat pumps, for example. I just got a heat pump for my pool. If Tesla had a heat pump, I would be buying that one because I know it'll be super efficient. So I think there'll be a lot of other things that they'll be able to do, flow on technology that'll come from all the engineering that they're doing, right? So they're an engineering and R&D company. So I'm not really worried about that at all. I think this is great. Actually, this is absolutely Elon showing that he is not just a visionary, but also a great person to run a company. Actually, from an operations point of view, people have called for a long time, we need a CEO. You don't need a CEO. He's doing a fantastic job of that as well.
I think there are a couple of really good points on that. When he basically made the point about Cybertruck, of course, you can produce anything at any cost, but he said it's not about producing the Cybertruck at any cost. It has to be affordable. We want to do a 250,000 run rate. It's not about, throwing out, a one-off, two-off, three-off, car or via truck in that respect. And I also thought he touched very interestingly on too, off the cash flow, how much is being generated, that they will be looking at building other manufacturing plants, gigafactories down the track. Now, he said, don't expect anything overnight. We may be announcing something towards the end of the year. Obviously, India has been touted, the UK or whatever, but there are so many plans running underneath the surface. But you're absolutely right. He's far more I would say, pragmatic about making the business profitable and generating the cash flow than I think sometimes people give him benefit for, because he's got that engineering genius, he's got that creativity and imagination. And you see that in the call where his mind starts going off in another direction, whereas Zach would prefer to pull him back and just go through the script. So if you don't understand that balance, but I think there were multiple examples of where the practicalities of this is a listed company, we need to generate profits, we need to grow our profits, we need to cut our costs. You know, they're fully cognizant that they're still in a supply chain constrained environment that could run through this year. So you can see how people will pick and choose out of the narratives or what was presented today. I think some will choose the negatives, like supply chain costs are still going to be high, and oh my God, Cybertruck mightn't come on board, yada, yada, yada. Well, let's just maybe touch on briefly FSD, because that was a big theme today. And it certainly wasn't something that I was expecting. Elon's often very criticized for pumping up some of the themes like FSD. How did you read what he put forward today?
Look, I don't have the FSD beta package. I have the FSD package as available here in Australia. I drive my car always on autopilot. Basically, I have it in autopilot all the time. And I have seen lots of improvements. Sometimes it's very hard to see the improvement because they're happening at such quick frequency. But if you go back you go back to when I had the car and you think about that time and now, you sort of realize how much things have changed and how quick and how fast the pace of innovation is, right? And so I do think that the FSD beta is really, and based on videos that I've seen, is really evolving at a fast pace. I don't know whether the timelines, again, Elon is known for very aggressive timelines. I don't know whether the timeline of this year makes sense. And the other thing I don't know is my big question right now is, I think the way they're developing this, they collect data, they fit it to that data, they run the models, and then the models sort of figure out, okay, what else is going to work, and when it doesn't work, again, there's an intervention, again, it learns, right? So I think the model is fitted heavily towards certain markets where there's high uptake of their vehicles and therefore higher uptake of FSD, because FSD beta is really given to those people who have purchased FSD, right? So my question really would be, how much of their solution is still heavily localizing versus global, whether it's a global, Elon likes to call it a global solution. It's not a really global solution, because he hinted at that to one of the replies I read that he had for someone who was asking from Canada. He said, like, look, 90% of the things will carry over, but there'll be these subtle differences that we need to essentially retune, program. You have to repeat that everywhere. So I think one of the things that we need to think about and realize is when he says FSD would be ready, I think what it really means is FSD will be ready for some markets. Yeah, that's number one. And it'll be ready sort of in a limited form. I think initially it'll probably be FSD is available, but it's more like an Uber type of platform where you have still a driver who is responsible. So it's not level 5, as people like to call it, level 1, 2, 3, 4. It'll still be level 2, right? Yeah. But it'll be just getting very, very close to level 5 in due course. So, and I think that is a big step change. I have always held that solving the full self-driving problem, it's like solving one of the hardest artificial intelligence problems that exist today. The company that gets there first basically would have solved one of the most fundamentally challenging problems. And therefore, you could also assume you can make some very simple extrapolations, right? The process to get there involves working at the cutting edge of technology, also involves developing cutting edge solutions. Those solutions then have, forks that you can use and apply at other places. So when he then talks about, the robot and things like that, all of those things really had a flow-on effect of their work in this cutting edge space. So there's a lot of things that, I think analysts tend to ignore. At least from an optionality point of view, we have to probabilistically say there's a certain probability of that happening. If that happens, then there is a probability of those other things happening, and those other things have a lot of value. So yeah, I assign that a lot of significant weight. And the final thing I'll say here, and I've been rambling for long, is, Elon says I'll do X, Y, and Z, and I'll do it by this time. He's generally very good with making predictions about I'll do it, means he's going to do it. It might be delayed, but he's going to do it. It's just like, with each of his products and so on, he says, I'm going to send a rocket there, it's going to go there. Initially it might not, but eventually it's going to go there. So he's really, really, first principles thinker. So I think that FSD is right now not being valued by most people. But yeah, it's a very important component, and that'll change the game in terms of margins.
Yeah, and I think that's a really good point you made when they talked about the insurance product being in 5 states and it's being quite effective in terms of once people know that their driving is being monitored, they actually improve their driving. And the fact that insurance they're trying to roll out across more states is indicative of potentially like the FSD, because you've got lots of regulation or regulatory hurdles to get through, and it's not just suddenly going to be a global thing. And you can see that with the product lines. Australia, we're still do not have as much infrastructure as Norway, even UK, Europe, America. Yeah, so it is really interesting. I mean, it's very hard though for the traditional investors to capture the story, the idea, and ascribe a valuation, because ultimately, if he gets like the Optimus Prime up and working, the robots basically is what I'm referring to, which obviously he said it would be for our factories, it would be for our operations. If we cannot have application of those robots with us, then how the hell can we sell them anywhere else? Whether it's FSD, whether it's Dojo, their supercomputer or whatever, they're all going to have applications to improve the business, but it's not something tangible. It's almost like a biotech, isn't it? You've got all this technology, you've got all this R&D, but there's a lot of what ifs down the track. And I think that's why traditional analysts will always bring it back to, look, at the end of the day, this is a motor vehicle manufacturing company at this point in time, even though as an engineer, you would argue vehemently against that. Me, as somebody who observes, listens a lot, I would also argue that the technology is so supreme compared to any existing car manufacturer.
Yeah. So right now, actually, if you think about it, like the money was to think about this, right? Like, as you just said, the technology that they're developing is not being developed by other OEMs, right? Then the other OEMs are not robotics companies. They don't own Tesla, Grumman, which they bought out of Germany, and they pulled the rug out of all the other German manufacturers who were using them. So it's like buying the Kiva Robotics that Amazon did many years ago. The other auto manufacturers are not energy companies. They're not trading energy. They're not making mega packs and things like that. They're also not producing cells, right? They don't have a cell factory, cell design engineering. So there's also that, and they're not doing software. They don't know how to do GUIs, user interfaces and design their own interfaces and software. So I think I would have thought this is the argument that should be dead by now, that Tesla is an auto company, but it's not. I find that it's funny. The other thing is, which auto company? I mean, if you look at, so this quarter's earnings growth was what, 200%, right? Which auto company is growing at 200%? Right now, the value, probably on a forward basis on consensus, maybe 60 times earnings for
probably
a company.
Around that, yeah.
60 times earnings for a company that's growing earnings at like 200% or something like that. You have to be nutty to say that's expensive. You have to have a very strong opinion about stuff. And it sounds odd to say it's not expensive, given it's close to $1 trillion in valuation. But, you look at the free cash flow and the potential for the free cash flow to continue growing and all these other things, then you realize, well, maybe it's not that outlandish, right?
Yeah.
So I don't know.
No,
I'm in your camp.
Yeah. And there was I briefly touched on, if people want to follow Pierre Ferragu, who's an independent analyst in Paris. And he did some back of the envelope calculations about free cash flow, and you can look up his tweets. And basically, even if the business only grows at a compound rate of 35%, which is feasible, assuming, assuming we don't have some geopolitical, nightmare that erupts in our faces over the next few years, and assuming the factories come on board, etc., this company can produce up to 500 billion in free cash flow by 2030. And those are eye-watering numbers when you think about the leverage that one gets off that. Their balance sheet, as you said, already has 17 billion. And then you go, well, my gosh, what are they going to do with all this cash? Well, we know he probably wants to go to Mars, but he can't just siphon it all out of Tesla immediately. But it really begs the point, I think, of post the whole narrative about inflation being here, about interest rates going up, about what type of companies investors want to own, because I briefly wanted to touch on the macro. And I think this is one of the hardest things for investors, is to separate out companies that have cheap valuations. We've had that rotation in there to more value-orientated stocks. But as you rightly said, the incumbent car manufacturers really, it'll be very interesting to see the results. But as far as I can tell with Ford, most of the uplift is coming out of the sale of Rivian. They've really struggled this year. There's lots of Mary Barra from GM talking about, we're going to do like a Cybertruck, and we're going to do this, and we're going to do that, and we're going to produce 1 million vehicles, by 2025. But like, whoa, the horse has bolted. But I think investors, when they are confronted with this narrative of higher interest rates, higher inflation, one has to go back to the core fundamentals of how one invests. And ultimately, it's strong balance sheet, it's pricing power, it's cash flow, and it's a strong brand. You can buy something that's dirt cheap because you think you might get a valuation, or they've got a high yield, but that's potentially a value trap. So the question becomes, when the recalibration of the multiples comes, interestingly enough, Tesla's multiples been compressed down this year. The stock's only off 25%, some are off 70%. But as you said, it's growing 200%. So you can actually see the compression on the multiple. Normally the stock would have gone up if we'd been, a year ago. So have you got any thoughts for investors on how they evaluate all these different narratives on valuation?
Yeah, so ultimately valuation, it goes to the textbook definition of valuation, right? So the valuation of a company today should be the sum of the discounted free cash flow into the future, right? And you can use peers numbers if you want as an example to make a calculation, right? So I think number one thing is, one of the reasons I believe that Tesla has not contracted as much as some of the other high growth names and higher valuation names is that it has free cash flow. And people have realized that the free cash flow is growing, right? So I think watching for your free cash flow and where that free cash flow is coming from, how it is growing, where is the leverage, I think is important. I would also say this time that a lot of stocks have pulled back a lot more than they probably should, because, and you can make an argument that many of them are cheap because, again, the market works in funny ways, right? It goes to the upside with exuberance, and then goes to the downside with pessimism, right? So right now in that pessimist phase where, every I guess the growth sector has been hit very hard, growth, whether it's growth biotech, growth software, or growth whatever, mid cap, small cap basically has been hit much harder than some of the ones that are generating free cash flow, because again, because of the interest rate dynamic, right? I tend to not pay too much attention to what's going to happen to the interest rate today, largely because, effectively, if you think about growth companies, then a lot of value is accreting into the future in the terminal value, really, right? What is going to happen in the future? And if you asked me in 2000 to, figure that out for Amazon in 2020, it'd be really, really hard game to do, right? So I just tend to think of the macro in more general terms and say, well, look, interest rates are near zero right now. Well, the only direction they can technically go, unless the world is coming to an end, is up, right? We could have negative interest rate. That's another scenario, but we don't want to go there. And given high inflation, that almost, is there any direction it can go? It's going to go up. But how much is the question I have? And I don't think the interest rate can go up that much, but I think somewhere between 2 and 2.5% would be very, very reasonable. And if the market is unhappy about the fact that, we're going from 0 to 2.5%, and they're going to be really, really like, in panic mode because of that, well, then there's nothing we can do about that. And we just have to ride it. I mean, get some opportunities along the way for that. But I think I listened to, I read some of the comments that came from Jay Powell, and I thought, well, they're making sense. It makes sense. One thing that I think is often forgotten maybe is that the US is looking to increase interest rates. That is going to push the dollar to become more expensive or stronger relative to other currencies, assuming those other currencies are not pushing for
rate hikes.
Rate hikes. That basically means that for two things. It means that US exports are less competitive, right? That's a fuzzy thing because of the way supply chains work and production works these days, right? It's not really US export. A US company might have production like Tesla does in China. So really it's shielded from some of those impacts. But there is another impact that we need to be aware of, which is the international earnings. A lot of the US listed companies, 60-70% of their earnings come from overseas in some cases.
So it's earnings on translation in US dollars that gets hit. Same for Australian companies. There's a lot, CSL, ResMed.
That's going to be hit.
Even the moment iron ore prices are rising. But and you've seen that from Salesforce, you've seen that Adobe have cried that as well. Netflix have cried that as well. All of them, because they have international earnings. And it's that concept of the US dollar strength is actually really important, because people forget that even China is very concerned about the Fed tightening, because there's so much US dollar denominated debt, particularly in their property sector in China. And emerging markets, for those who haven't lived through the Asian currency crisis like I did and the collapse of long-term capital management, higher US interest rates is very deleterious to them servicing their payments. And that's why you have seen countries like Turkey and those absolutely jacking up their rates through the roof. So it effectively crunches economic growth there. So, buying emerging markets in a tightening cycle is not always an easy one. Let's just put that. And I think that whole concept, when you talk about the neutral rate, so neutral rate being where interest rates move to, you mentioned 2.5%. It's really going to be interesting, because there's a massive debate in the press at the moment whether the Fed put, so for people to understand, typically when Jay Powell's tried to raise rates in the past, the system grinds to a halt and he has to backtrack. And of course, I think a lot of people now are really going to test him on this one. So I don't think anyone knows the outcome. Nobody really knows how embedded inflationary expectations have become, how much the secular long-term themes of deflation, disinflation, aging populations, technology. I mean, just even listening to Elon talk about the robots, I mean, he basically said, oh my gosh, if economic growth is built on the labor force, but yet we turn that into a low-cost robotic force, what does that do to an economy? And I think the only way, how I'm personally handling it, is you've just got to have cash this year. And, because there are going to be some great buying opportunities. There are probably some now. Bill Ackman came out today and said he bought a 5% stake in Netflix. So there are going to be opportunities, because you're absolutely right. Everything that was overdone to the upside is going to be done to the downside. And one could argue that there were a lot of aberrations last year.
Yes, absolutely. Yeah. So there were a lot of aberrations last year. And I think, that's the funny thing with the market. There's aberrations to the upside and aberrations to the downside.
Exactly.
Right? So cash, I think, cash is a underrated hedge.
Correct.
In your portfolio. People actually don't realize that cash is an underrated hedge, but everything can go down, but your cash can't go down. So
in fact, proportionally, your cash becomes a larger percentage.
Exactly. Your cash holding becomes larger. So, that's what I think that's really, really useful to be smart with cash. I think it makes sense. I agree with that 100%. The other thing I'll say is that I think in any time, but more so in these sort of times, I think if the two types of things one can do as an investor is, probably, I guess, digressing, but this is what I do. There's a tendency when the market is going down to go for defensive companies. That's probably the wrong time to buy a defensive companies, because they don't fall as much, right? And defensive companies, by definition, probably have less growth, So
Yeah.
what you want to buy is you want to buy high growth companies that have potential for generation of free cash flow into the future that have fallen a lot. That's the one that's probably going to give you the best bang for the buck, right?
Yeah.
So high beta might actually be the better thing, because they've fallen a lot and therefore have the potential for rising more. But there's a tendency to flip. People actually sell at the wrong time. They will sell and then go for this defensive. Buy Procter and Gamble as an example, because or whatever, Colgate Palmolive.
Yeah, I know. I actually hold Procter and Gamble, and it hit the 52-week high, and I thought, I better flick this now. And of course, they're stupid. I haven't done that yet, but that's absolutely right. From a portfolio construction, I did park some cash in those defensives a while back. And arguably, I switched out of super high growth stocks into more value growth stocks. And of course, the problem is they're falling too, but they're just not falling as much. So arguably, my mistake was actually just not going to a much higher cash weighting soon. But I think you're absolutely right. If people are trying to construct portfolios, I actually sold my US, S&P ETF because I'd made so much money on it. So for me, that's a great way to galvanize cash, because if the market's going to take a real tumble, we know, the apples, Amazon, will see with the results, but once they start to tip. Anyway, we're getting off into different territory, but that was so fun. Lovely to chat, try and give people some context around Tesla, and also Tesla in the context of a growth stock, and then also the context of growth stocks within this whole paradigm of, is the world going to end? Because, the 40 years of interest rates coming down is gone forever, and we're going back to the late 70s. For anyone, you're too young, I would strongly recommend we don't go back there. It wasn't a whole lot of fun.
Let's stay in the low interest rate environment permanently.
Yeah. Exactly. And nor do we want the whole financial system to start to go into gyrations. And I think if there are two people in the world I wouldn't want to be at the moment, one would be Jerome Powell and one would be Biden, with Russia potentially attacking the Ukraine, and then China after the Olympics going, maybe it's time to have a go at Taiwan.
Yes, that's a geopolitical.
Yeah, anyway, thank you, Anirban. That was lovely. And you stay well and stay safe. And I'll catch you on Twitter.
Thank you very much for having me.
Cheers.
Cheers. Bye-bye.